You know, last week, Federal Reserve officials raised interest rates, leaving many worried about the impact on our wallets. Local financial professional John Vandergriff from Blue Ridge Wealth Planners is here to share what this interest rate hike means for all of us. So first of all, thanks a lot, John, for coming in. I know it's something that a lot of people are talking about right now. Let's talk about, first of all, just the hike itself. How much are we talking here?
Yeah, and so there was concern of that being more than people wanted. So 1/4% is what they did, and so most people say that doesn't sound like much. The anticipation is that they may do as many as 6 more of those.
Right.
When, in some of the most recent news, some of those could be 1/2 point. And so as we look at that, that's going to have some impacts on things as we move forward.
Yeah, definitely. All right, so let's kind of go back here for a minute. Why did they decide to do this now?
So this is in response to the really hot economy, and so you've heard all the time people talking about inflation and how expensive things are getting. So one of the moves that the Fed does is to raise interest rates, is to try to slow down economic activity, make it harder to borrow money so that we can try to get this inflation to the target rate of around 2%.
Okay. Yeah, because that was one of the things you first heard was as soon as you heard about the rate hike, people started thinking, okay, wait a minute, borrowing money, you know, cars, homes, student loans, you name it, things like that. All right, so, and we just kind of touched on it as far as how this is going to impact us. How does this impact us when it comes to our wallets, when we're trying to borrow? Just kind of go the whole spectrum here.
Yeah, and so, you know, as we were talking off air, you know, most people think, oh, interest rates are going up. That means my bank accounts are going to finally start making something. The place that we see the most immediate increase is on your debts, whether it's credit card debts or mortgage rates. One of the reasons that the housing market has been so hot is because interest rates have been so low.
Sure.
And so you're going to see that go up. You're going to see that go up really on every debt level, and your savings accounts are going to start to lag behind. You know, as we said, banks will pay you as little as they can for as long as they can. And so you don't be surprised if you see those savings rates not creep up very soon. But I think the biggest impact that we're going to see is twofold in investments. Stock market has had a lot of reason for volatility lately with everything going on in Ukraine, inflation, interest rates here, and the concern with that. But I think the bigger impact is those of you that are carrying large amounts in bonds. When interest rates increase, bond values go down. And that's something that's directly connected. And so if we have as many as 6 interest rate increases, if you're in a very heavy position in bonds, which is where most retirees are suggested to go to, finding alternatives may be a good idea so that you don't have what has historically been a safe asset that is just going to continually lose money, especially when we have some of the stock market volatility.
Sure. So this is really that time to sit down, kind of look at your portfolio, look what you've got going on, talk to a financial planner, make decisions going from there.
Yeah. If you've not revisited that in a while, making sure that you're talking to somebody and seeing if adjustments make sense is something that is a good idea.
John, as always, we appreciate it. Thank you, sir. Elizabeth, over to you.